Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, June 17th, 4:31 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show. Not so big this week, no 21 over 21 because of the state of the market, but we'll still call it the Big Show, where we take a look back at the prior week, take a look ahead at key levels for next week. And instead of the 21 over 21, I'm going to pick 5 stocks. If you absolutely made me buy 5 stocks today, here's the 5 that I would buy. So we'll take a look at those charts and I'll give you the reasons why for each one. So what happened today? Weak bounce ended a bad week. You can see over here on the trend gauge, we're still completely in bearish slash downtrend mode. Market leaders, no participation, and all 5 of the major indexes are below their short-term 21-day exponential moving average, their medium-term 50-day moving average, and their long-term 200-day moving average. And that we're in stay away mode. We own 0 individual positions right now. The only thing we have is a 10% size in VTIP, which is a short-term inflation-protected bond, basically a money market fund. And then we hold a 5% position in GLD, which is it's going to struggle as long as the dollar stays strong. Hasn't hit our stop yet, but not the best looking chart, but we'll take a look at that as well. So as I said, weak bounce ends a bad week. There is some green here, but when you consider how far extended we are to the downside from the moving averages, this is a pretty anemic close to the week. G6 up 0.89%. Maybe you call this the lone bright spot today. Growth stocks did outperform. The growth indexes did outperform. S&P 500 up 0.22%. NASDAQ 100 was the leader, up 1.2%. Dow down 0.13. Midcaps up 0.9. Russell up 1%. Global diversified 60/40 stock and bond index up 0.09%. GROTECTION down 0.06%. We were up 3 days this week, down 2 days, and considering that the S&P was down 5.8% for the week, we'll definitely take that. So let's get into the charts, but first, let's take a look at the team at Revere here. Trend following is what we do. When the markets are in an uptrend, we participate. When they're consolidating, we take a step back. When they're in a downtrend, as they are right now, we get the heck out of the way, especially when they are below the critical 200-day moving average, which the indexes have been for quite a while. That's where risk is extremely high. That's where we get maximally defensive. That's how we've dodged this 20+% sell-off in the S&P 500 year to date. We're down about 8%. If you're interested in this approach, learning more about it, email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Here's the tail of the tape. And here is a daily chart of the S&P 500, and this is ugly, folks. So taking a step back, you can see this consolidation from the prior 2 weeks above the 21-day exponential moving average. That was the good. We actually did take a few positions in here and some charts that were looking pretty good. Here's the bad. It was happening under the declining 50-day moving average and, of course, below the 200-day moving average. But if you're going to get back into the market, this is the first step that we take. We get back above the 21-day moving average. We want to participate. It might be the beginning of an uptrend, or it might not be. In this case, it wasn't. We got stopped out for a less than 2% overall loss to the portfolio when we broke down here below the 21, then follow through to the downside on the 10th. And then the Fed did not help. The Fed was on Wednesday. We had a gap down follow through on Monday, undercut on Tuesday. Little bit of exuberance on Wednesday. Let's take a 15-minute chart here so you can see. So here's the Fed, where we, and this is very typical of Fed reactions. The algos hit the stops on the upside, and then to the downside. Big move into the close. All that was short covering. We put in a flag formation, and if you're looking the next day for some follow through to it, not a chance of that, as we gap down 2.3% at the open, and this is where we've been hanging around the last couple of days. Basically, the lows from Tuesday, this 3705 ish area, acting as resistance now as we tried to get above it intraday today, but we couldn't. So very bearish look. The rubber band is stretched to the downside. We're 10.8% below the 50-day moving average. That's historically extended. We're 6.7% below the 21. That's also pretty far extended. I would not be surprised to see a bounce here at any time. I actually kind of wouldn't have been surprised to see it at all today. We always have expectations coming into the day, and also, a bunch of if-then-else scenarios that happen. Maybe with quad witching today, some fireworks and a short covering hard rally, but we didn't see any of that. Just a weak, anemic intraday action. If you look at a 5-minute chart, it was an inside day compared to yesterday, and just kind of meandering. Formed a cup and handle intraday, tried to break out, that failed. Again, this 3705 area from earlier this week, acting as some resistance, short-term resistance anyway, and just a weak close, and really nothing here to write home about in any way, shape, or form. Note stochastics, however, are getting to oversold, and a hook up here, and the fact that we're extended to the downside, we may take a tactical long at some point next week with the intention of selling that to take a quick profit if we go into the 8 or the 21 EMA and look to get short again. This is a big resistance area here at this 3,900 area, also at the 3,800 area. So we'll watch how the moving averages and the horizontal support act as we get into those levels. Let's get to the NASDAQ 100. Here's the Qs, and that's ugly also. Let me get rid of these stochastics to blow this up a little bit. Ugly also, really the same situation as the S&P 500. We're going to take our cues from the S&P 500 because of its diversification. This is tech heavy and has been underperforming. So yeah, we'll keep an eye on the relative strength line here to see if it starts outperforming. NASDAQ does typically lead to the upside and also to the downside. Here it led to the upside. You can see the positive relative strength on this bounce in March, and then it rolled over, led to the downside. You can see the relative weakness bottoming here in late May. So there's your NASDAQ 100, not looking so good. How about the Dow Jones Industrial Average? Yeah, that's ugly too. Really the same setup as the other indexes, showing some relative strength, which is typical as this is a more defensive index, showing some relative strength in the bear market. Let's go to mid caps. Pretty consistent here on the charts that we're looking at. There's really no positive divergence anywhere as we're making new lows here also, and IWM small caps new lows as well. So those are the indexes. That's ugly. What are we going to look at for next week? Let's get to the tail of the tape. Same headwinds that we've been talking about for months: strong dollar, inflation, Fed tapering / balance sheet reduction, rising interest rates, Russia, Ukraine. Maybe we get a surprise peace talks or ceasefire or something out of Russia, Ukraine. Seems like the administration in Washington needs something to turn around their poor approval ratings, but you never know. Sentiment, put call is mildly elevated at 1.16. VIX is at 31. Fear and greed is at 15. So we do have some negative sentiment there, but this isn't as reliable in bear markets unless it gets absolutely to an extreme, like maybe if the put call spikes up to 1.415, the VIX gets up near 40, and the fear and greed gets to single digits, and then we get a big washout. That would be a signal to possibly see at least a short-term low. News, again, well, we're operating under our bear case. Let me step back there since we had the 610 failure of the rally last Friday. News, Fed reiterated to Congress in a statement today that they have unconditional commitment to fighting inflation. That's probably going to cause a recession, and that's probably why the market isn't bouncing much. But we're not going to guess. We really don't need a reason. We're going to take our cues, as always, from the price and volume action. What we're looking at coming into today, recent support 3640 to the downside on the S&P. We undercut and reclaimed that as today's low was 3637, and then on the upside 3720 to 3735 was resistance. We got as high as 3708, but early in the day before turning back lower. As I said today, inside choppy day, no real OPEX fireworks. Sectors, the US dollar continued to be strong. Let's take a look at that chart, UUP. Negative reversal on Fed Wednesday, followed through to the downside on Thursday with the gap down. But reclaiming that strength today. As long as that's strong, gold's going to struggle. Biotech strong today. Let's take a look at the XBI, one of the biotech indexes. I mean, it's beaten down and it bounced. Big deal. Up 5.7%. That doesn't get me excited. KWEB. This is something. The China Central Bank is the only central bank that is actually easing, and as a result, you're seeing relative strength in their markets. KWEB is the U.S. listed China big tech. There's a risk here in that we're still discussing delisting some of these because they won't adhere to our audit requirements for their financials. On the other end, A-share, these are just China listed stocks also showing relative strength because the Chinese government has been seen as more accommodative lately after they put the boot on big tech over in China. They're easing some of that. They put the boot down on the gaming companies. They've eased some of that. They're trying to stimulate their economy after a recent COVID lockdown. So money goes to where it's treated best, and particularly where the bank authorities are going to treat it best. And although I would hate investing in this corrupt communist government, we do have a fiduciary duty to make money for our clients, and so we do seek out relative strength, and this is certainly on the list of something that we would consider buying. So bottom line, okay, let's finish this. TAN, KBE, IGV, those were all strong today. KBE is banks, IGV is software, TAN is the solar index, but most of them are oversold, so really just bounces. TAN at least forming a cup and handle, but it's below the 200-day moving average. We did see some recent strength in some solar stocks. On the downside, oils have really come apart now. Let's take a look at these oil indexes. These were the last. These were the piano player in the house of ill repute, and finally, when they raid the house, they get them all, including the piano player. And look at these big sell-offs. We saw a similar sell-off to this in staples a couple of weeks ago, and utilities, as those were some of the last places where money was hiding. Let's take a look at XLU here. You can see how that came apart. Let's take a look at XLP. You can see how that came apart. XLE was the last place, and it gave it up over the last week and a half, breaking the 50-day moving average, still above the 200-day moving average, though. So is the oil outperformance over? We're going to keep an eye on this, but you don't like to see the distribution like this and really the breakdown of anything that was looking like it had a healthy pattern. Here's XOP. This is the producers. XLE is dominated by Chevron and Exxon. This is the producers also breaking exploration and production, also breaking the 50-day moving average. OIH is the service stocks coming down and bouncing at the 200-day moving average. This is kind of interesting. The 200-day moving average is a place where managers bring some money in to try to take advantage of lower prices, but with the entire patch breaking down, it may be just throwing good money after bad after this extreme sell-off. So bottom line for today, we're staying oversold, extended 11% below the 50-day moving average, which, as I said, the rubber band is stretched, but very few reasons for things to be looking up. However, I do want to point out when pessimism is at its maximum, there's usually a contrary indicator. it's a country indicator and often sparks rallies. In this case, rallies should be sold because there is no leadership. That's what we would be looking to do, is to actually short into declining moving averages, or if we took a tactical long, as I mentioned before, we would sell it into those moving averages and then flip to the short side. So that's our current plan right now, as we are operating under a bear case. So the key levels that we're looking at, you can see all of this overhead resistance here. We've got the 200-day, the 50-day, and the 21-day declining. We're under there. We do have some support here. As you can see over here, maybe the most extreme downside target would be 35.05, which is 50% retracement of the entire COVID rally from low to high. These Fibonacci levels often get tested and taken out, and their targets. So keep an eye on that area. You can see up here the 38.2% fib in the 3800 area held for a while before giving way, and we're of course underneath that now. So those are some key levels to keep an eye on for next week. Now, 5 stocks. If you told me I absolutely had to buy 5 things today, here's what they would be. Zoom. This is the lone survivor of the 21 over 21 list. They have seen money come into them since their earnings report. The day of their earnings, up on 450% above average volume, up 5.6%, and it's holding it. Let's go to a 60-minute chart here. And you can see formed a little cup here, going sideways. It's not going lower, and you can't say that about a lot of stocks in the market. It's holding above the 21-day. It's now got a reasonable PE, and they do make money. So Zoom would be one of them, one of the stocks that I would have to buy. Another one is a Chinese stock, Li Auto. I mean, this is just a really nice chart. EVs in China, as I said, the government stimulating, very great relative strength here with the stock testing recent highs going back to November. It's just a good looking chart. It's got great volume patterns. Look at the blue bar spikes on positive days. Good numbers from their last earnings report. So that would be number 2. Number 3 would be Ali. This is a discount store. They buy in bulk when other places are trying to blow things out. They buy them cheap, they sell them cheap, and they make money. As you can see over here, Ali profitable going all the way back to 2016. 48% earnings growth with a 33 PE gives you a okay PEG ratio. Since they reported earnings here, they're showing relative strength. They got back above the 200-day moving average, and they're above the 21 and the 50. Nothing wrong with that. Dollar General would be an honorable mention as another discount store. I'll show that one real quick. There's DG pulling back from its recent run up here in this big shakeout after the Walmart panic. Showing a cup and handle, holding on to the 21-day moving average, but I would prefer Ali over that. That would be number 3. Number 4 would be UTHR. This is a biotech stock. Big move up here, decent reaction to its last earnings. They make money. It only has a PE of 13. They develop therapies to treat cardiovascular and infectious diseases and cancer, pulling back from its breakout of this big flat base, holding on to its 21-day exponential moving average. This one looks good. And last but not least, I would take a shot at Schlumberger. With the harsh pullback in oils, this 200-day moving average for this, and this 37 level. 37 was the breakout from this big base over here. 37 was the bottom of this flat base right here that it recently broke out of. So it's coming back near the bottom of that base. Those two levels combined with the 200-day moving average being right at this 3750-ish area. You can give it a couple of percent below here, but this would be my number 5 in the 5 if I had to buy 5 stocks today. And that's going to wrap it. As always, love to hear from you. Love your feedback. Email us, don@revereasset.com, or phone 855-REAL-WEALTH. Be on the lookout this weekend. I did an interview with trading content connoisseur Richard Moglen. He's on Twitter at Richard Moglen, Moglen. Had a great interview. We discussed our full process, and Had a lot of fun, and I hope you enjoy it. We'll be sending it out to clients and anybody on our email list. So, wrapping up the week ending June 17th, this is Don Vandenbord with Just the Facts, telling it like it is, folks. Price and volume, those are the facts. Opinions don't mean a thing. Take that advice, and it will save you mental capital as well as financial capital. Have a great weekend, 3-day weekend. Markets are closed on Monday. We'll be back with our next video on Tuesday. Thank you very much.